Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. This week saw the price of crude oil spike above $70 a barrel after Houthi rebels in war-torn Yemen attacked two Saudi Arabian oil installations with attack drones. The attacks followed hot on the heels of OPEC's decision not to increase production in the face of rising global demand for oil. Saudi Arabia leads a Sunni Muslim coalition which is fighting to subdue the Iranian-backed Shiite Houthis. As of last night, more than 119 million people have been infected with COVID-19 worldwide, and over 2.6 million people have succumbed to the disease. The United States remains hardest hit, with more than 30 million infections and more than 543,000 deaths. Brazil, India, Britain, and Russia make up the top five, and South Africa is still the country with the 16th most recorded cases. Most countries on Earth have now managed to contain the spread of the coronavirus, with the notable exception of Brazil. Here, more than 65,000 new cases were reported daily for the past week, due to the president's cavalier attitude to the pandemic, coupled to administrative bungling and corruption. The daily death toll is also falling everywhere except Brazil. In the United States, the Biden administration has achieved a lot during its first 50 days, including a reduction of more than 50% in the daily mortality rate. Mexico and Britain are the other two major countries which have made great strides in saving the lives of their people. After a number of growing pains, mass vaccination programs are now in full swing in most industrialized countries. The United States is about to reach the 100 million mark, China is approaching 60 million vaccinations, the EU is at 45 million, and India and the United Kingdom are on either side of 25 million. For the world as a whole, the total is now just over 330 million people. The OECD has raised its global growth forecast due in large part to the massive fiscal stimulus about to be unleashed in the United States. Bond yields are down, but the oil price is set to continue rising. Business confidence and job creation in America are on the up, and China has surprised pundits with a modest growth target for 2021. The JP Morgan Global Purchasing Managers Index for February reflects the optimism that the advent of COVID vaccines has triggered. The rise in the headline PMI number, the blue line, is mainly due to the strong reading for manufacturing, the grey line. The services sector, represented by the green line, came in lower but is trending upwards. The key determinant of how the global economy and investment markets will fare this year is inflation. If inflation rises sharply, central banks will have to raise interest rates, and that could derail the much anticipated global economic recovery. Pessimists fear that all the monetary and fiscal stimulus being applied will lead to a classic case of too much money chasing too few goods. Some point to the sharp rise in American personal incomes, the blue line, and worry about what will happen when consumer confidence returns and people start spending their surplus cash. The phenomenon I described in the previous slide is known as demand-led inflation. The other common cause of inflation is known as cost-push inflation and occurs when the prices of necessities like food, transport, and accommodation rise. In recent months, food prices have risen considerably all over the world and added to fears about inflation and higher interest rates. Consumer price inflation is usually recorded in two ways: The headline number, the purple line, and the core number, the blue line. Core inflation strips out volatile items like food and fuel prices. The recent rises in such prices have led experts to warn that headline CPI in the United States could double from 1.5% to 3% by the second half of this year. We believe, however, that this will only be a temporary development because core inflation, which is demand-led, remains subdued, and the headline rate will come down once food and fuel prices stabilize at their new higher levels. Two developments dominated global markets this week: a rebound on equity markets and the continued rotation out of technology stocks into cheaper cyclical shares. The latter saw the Dow Jones Industrial Index and the DAX in Germany reach new highs. Concerns over slower growth in China dogged the various indices there, and lower bond yields weakened the dollar. Commodity prices also trended lower, and Elon Musk recouped some of last week's losses as the Tesla share price recovered. One of the main drivers of the rebound on equity markets this week was a modest but significant reduction in US bond yields. This reflects a growing belief that inflation is not going to spiral out of control and that interest rates will not have to rise soon. Higher interest rates would obviously dampen economic growth and thereby put pressure on company results. 2021 has thus far been a funny old year on equity markets. Some of last year's stars, like the Nasdaq and mainland China's A50 index, have had a torrid time of it for the year to date. The surge in US mid-cap companies has made the Russell 2000 the best performing major index over 12 months, while the JSE Top 40 is the world's top broad-based index for the year to date. The CAC 40 in Paris took the honors for the past 30 days and the Russell 2000 for the past week. This infographic depicts the extent of the rotation out of technology into more cyclical financial and industrial shares. In recent weeks, the Nasdaq 100, which is technology-heavy, has declined by around 10%, while the Dow Jones Industrial Index, which is dominated by more traditional blue chips, has been rising. This reflects a growing belief that COVID will be beaten and that things will return to more or less normal in the course of this year. February saw a general surge in industrial commodity prices, with crude oil leading the way. Gold, on the other hand, has been retreating all year. Now fears over higher interest rates have clouded the growth outlook and caused commodity prices to pull back somewhat. Oil has been resilient because OPEC continues curtailing output even as demand rises. The outlook for gold remains uncertain and depends on whether inflation picks up and how central banks react to it if it does. We remain positive about global equities, but we expect a continued rotation out of technology to more cyclical sectors. We also expect emerging markets to outperform developed markets, the East, the West, and Europe, the United States. The biggest risk to the equity market is rising bond yields. We remain skeptical about fixed income where yields are still negligible. We worry about the inflation fears that could trigger a fully fledged sell-off. We remain neutral about property, which, whilst cheaper than pure equities and yielding better than bonds, are. Here at home, the joy over the relaxation of the lockdown was diminished somewhat this week by the news that Eskom would be implementing stage 2 load shedding again. The economy cannot recover sustainably without a reliable, affordable supply of power. Eskom CEO Andre de Ruyter has meanwhile been accused of racism by disgruntled former employees, and the ensuing official inquiry is bound to disrupt efforts to steady the ship. As of last night, more than 1.5 million South Africans have been infected with COVID-19, and the death toll to date is now over 51,000. Yesterday, 1,500 odd infections were reported and 109 people died of the virus. Gauteng still has the most cases to date, with the Western Cape the highest death toll. KwaZulu-Natal has the most active cases, and nearly 130,000 healthcare workers have so far been vaccinated. According to the Bureau for Economic Research, our GDP shrank by 7% last year and will take 3 years to make up the lost ground at current growth rates. There was an encouraging rebound in the fourth quarter, but Eskom's ongoing strife could slow down the economy's recovery. A record maize crop means that upward pressure on food prices should subside, but the tourism industry, which employs 1 in 9 South African workers, is still battling. Meanwhile, the Lesotho Highlands Water Project will only start providing Gauteng with water by 2027 at the earliest. Thanks to a strong rebound in growth during the fourth quarter of last year, South Africa's nominal GDP, the green line, is back above its pre-pandemic level. This does not, however, take inflation into account. The real GDP number, the blue line, strips out inflation and therefore provides a more accurate reflection of economic activity. As the graph shows, real GDP is still nearly 500 billion rand smaller than it was a year ago. The COVID-19 induced recession South Africa suffered last year has exacerbated both poverty and inequality. Before the pandemic, consumer price inflation, the dotted black line, was more or less equal to employee wage growth, the green line. Since the start of the initial lockdown, wage growth has recovered significantly, but it is still lagging consumer price inflation by more than 3 percentage points. Thanks to strong performances by resources and Naspers, the JSE All-Share Index has been one of the world's top-performing indices year to date. The Resources Index has risen by around 24%, with Sasol up a whopping 72%. Bond yields have drifted upwards, while the rand has retreated and then recovered somewhat. Sibanye-Stillwater wants to consolidate the local gold mining industry, and Old Mutual's UK cousin Quilter was rewarded by the market for releasing strong results. On the JSE, the Resources Index has been the standout performer for the year to date. This is largely due to the belief that a global economic recovery will fuel demand for raw materials. Experts warn that the rally in share prices might be overdone. The Resi 10 index, the brown line, is leaving the growth in earnings for that sector, the blue line, far behind. Valuations are consequently becoming stretched. One of the key takeaways from this year's budget speech was that government's debt burden is threatening to get out of hand. This is obviously of concern to bond investors, and last week saw net foreign selling of nearly 9.5 billion rands worth of South African bonds, even as foreigners were net buyers of South African shares. For the year to date, both markets have seen outflows, the bond exchange losing 26 billion rand and the JSE nearly 9 billion. Last week's sudden rise in US bond yields caused the dollar to strengthen considerably on currency markets. As a consequence, most emerging market currencies have retreated against the greenback. After touching 14.40 rand to the dollar 2 weeks ago, the rand has since slid back down to nearly 15.50 rand per dollar. Following the recent decline in bond yields, the dollar has weakened a little, and the rand is currently trading just below the 15 rand to the dollar level again. Locally, the equity market has been strong so far this year, but valuations are still fair and prospects for earnings growth look promising. Real bond yields remain attractive, but we remain mindful of risks to the fiscal outlook going forward. We continue to avoid listed property and regard cash merely as a liquidity tool because of the low interest rate it offers. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.